What's up, guys? Here is the first half of the 2021 half-year results presented on August 5th. Hope you enjoy.
Hello and welcome everyone to our 2021 half-year results presentation. With me here today are Warren East, CEO, and Panos Kakoullis, our recently appointed CFO. Warren will begin today's presentation with an overview of our first half performance before handing over to Panos for a more detailed review of our financial results. Warren will then conclude with an update as we look out to the future. In all, this should take less than 40 minutes, leaving time at the end for your questions. Before we begin, please take note of the Safe Harbour statement on slide 2. This results presentation contains forward-looking statements that involve risk and uncertainty, which may cause the actual results to differ materially. The full set of results materials can be downloaded from the Investor Relations section of our website. Thank you, and over to you, Warren.
Thank you, Isabel. Hello, everyone, and thank you for joining us for our virtual half-year results presentation. As Isabel mentioned, I'm very pleased to be joined today by our new CFO, Panos Kakoullis. Panos joined us in May, bringing with him a wealth of financial experience from over 30 years at Deloitte, and we're delighted to have you on board, Panos. Since our full-year results, we've also appointed a new chair, Anita Frew, who joined the board a month ago and will succeed Sir Ian Davis on the 1st of October. Anita is an experienced chair with in-depth experience from 2 decades of board appointments, both in the UK and internationally, and we look forward to utilising her skills for the benefit of the group. I'd also like to take this opportunity to thank Sir Ian Davis for his outstanding contribution and dedication to Rolls-Royce and his stamina. We wish him the very best for the future. This half we also appointed Mike Manley as non-executive director, and he joined the board from the 1st of July. Mike has led businesses in the automotive sector in Europe, Asia and the US, and we value what his capability and experience will bring to us. This half, however, has not only been busy in terms of board appointments, it's also been a great chance to get out on the road again. So here on the slide are a couple of examples. In late May, we opened our new testbed in Derby. Testbed 80 is the world's largest and smartest indoor aerospace testbed, and covers both production and experimental testing requirements. It was a major milestone for us. It's essentially a scientific instrument that's about the size of a cathedral, with the most advanced testing technology we've ever used. We were delighted to have the Right Honourable Kwasi Kwarteng, Secretary of State for the Department of Business, Energy and Industrial Strategy, to join us for the opening ceremony. I also recently joined UK rail operator Chiltern Railways as they celebrated their 25th anniversary, and they chose that event for the first journey on the public rail network for their new hybrid flex train. That was the result of a joint project that we've undertaken with Porterbrook, the UK's largest owner of passenger rolling stock, to bring hybrid trains to the UK network. The hybrid flex uses our MTU hybrid power pack, and Jens Gurchka with me in the picture is our engineer who's been babysitting it through several months of final trials and testing. This is just one of many examples of how our technology is playing a pivotal role in the transition to net zero. And we were absolutely delighted to be part of the groundbreaking team alongside Chiltern Railways and Porterbrook. And that hybrid flex is due to begin regular services in September. So now moving on and looking at our first half highlights. We've seen good progress and improvements in many areas across the group, and we're delivering on our commitments. Business performance is in line with our expectations and guidance, and we're moving forward with new business opportunities for future growth. In civil aerospace, we've made excellent progress with the restructuring programme, and I'll go into that in a bit more depth in a moment. Business aviation had a strong performance, with flying activity returning to levels that we last saw in 2019, and that's also been the case for our large engines that are operated on domestic routes in both the US and China. And in defence, there has been demand for technology-led solutions, with the US Department of Defence and the UK Ministry of Defence remaining completely committed to serious modernisation and decarbonisation of their fleets. In power systems, we've seen a recovery in our order intake and book-to-bill ratio, with orders up 19% year-on-year, led by demand improvements in all our markets, but particularly in marine, governmental and power generation. In June, we went public with our net zero pathway, and we announced targets which set out our plan to develop new technologies, accelerate the take-up of sustainable fuels, and drive step-change improvements in fuel efficiency. Now, as well as decarbonising our existing businesses, we're making disciplined investments in some exciting and potentially very significant new growth opportunities to lead the way to net zero power with our innovation and engineering excellence, and grow the civil aero business into subsectors that are new for us. Turning to the next slide, let's have a quick update on the progress that we've made on the restructuring program we announced 15 months ago. That's been focused on our civil aerospace business. We committed to a reduction of at least 9,000 roles across the group. To date, we've removed around 8,000, and we remain confident of reaching our target. That will be a reduction in civil aero of about a third of management roles, with commensurate reductions across staff functions, engineering and manufacturing. Our footprint rationalisation is progressing well. We launched our last large engine for assembly in Singapore as we consolidate that activity here in the UK. We've moved equipment from Crosspoint in the US, and ahead of closing that facility, the machines are already up and running in Derby and contributing to improved productivity there. And when complete, we will have consolidated 11 sites down to 6, delivering productivity and operational cost benefits. And that builds on our investments in efficiency that we made previously and we continued to roll out during 2020. So all in all, we're now achieving significant reductions in cycle times and overall productivity improvements. With CapEx reductions as well and operational cost improvements, we therefore remain on track to deliver cash cost savings of at least £1 billion in 2021 and over £1.3 billion of sustainable run rate savings by the end of 2022. And moving on to the next slide to summarise what this means for our financial performance. We've had a solid start to the year with improving cash flows and profits as expected. Our business split is looking more evenly balanced. Our underlying operating profit increased significantly at £307 million, and our free cash flow, though still in negative territory, was also markedly improved to just under £1.2 billion of cash outflow for the half as we transition towards positive cash generation. Our restructuring programme is delivering results, and as I said a moment ago, we expect to achieve over £1 billion in savings versus 2019 this year. This also makes us a leaner organisation with a lower break-even and much better operational gearing as growth resumes. And our disposal programme is also progressing well towards our target of at least £2 billion in proceeds. With £7.5 billion of liquidity and no maturities before 2024, we're confident our position is strong and not dependent on the pace of civil aerospace recovery. And in addition, of course, we expect to generate funds as we execute on our disposals activity. So I'll now hand over to Panos for a more detailed review of our results.
Good morning, everybody, and thank you, Warren. I'm delighted to be here taking you all through my first set of results. I'm very excited to have joined Warren and the rest of the Rolls-Royce leadership team in helping the business achieve its true potential in the coming years. And what attracted me most is the opportunity to help fulfil that potential by very clearly delivering on the commitments we have made, by building a balanced, profitable and cash-generative business, by getting the balance sheet back into good shape, and by helping capture the demand and upside created by the energy transition. So let's just move on to the numbers. Our half-year results, which we presented here on an underlying basis for the continuing businesses in the group, well, they show a solid start to the year. Our restructuring programme is very much on track and has helped to drive our return to profit in the period. Underlying revenue, that stayed steady, only 2% lower than the first half of 2020, and we've seen a much more balanced contribution from across the business units. Last year, well, the first quarter was relatively unaffected by the emerging pandemic and, as you'd expect, provides a challenging comparative, whilst the second quarter last year was severely impacted. In fact, April 2020 was the low point for industry flying hours. This half year has been much less volatile, despite some continued uncertainty with gradual recovery across the period. Operating profit was $307 million. This reflected the significant cost savings from the restructuring programme that was largely focused on civil aerospace. We've also benefited from some favourable timing and the mix of activity in both defence and power systems. In addition, last year's underlying operating loss of £1.6 billion included £1.2 billion of one-off charges in civil aerospace, mostly related to the impact of COVID-19. In the first half, we've incurred £174 million of financing costs. This primarily reflects the interest charges and facility fees on the debt and facilities that we secure to underpin our robust £7.5 billion liquidity position. That liquidity provides us with the confidence in our ability to withstand ongoing uncertainties around the pace of recovery in international travel. Financing costs in the prior period, they included a £1.5 billion one-off charge on closing the overhedge position. Turning now to civil aerospace. We've seen an overall improvement in performance driven by the significant cost actions we've taken. In addition, we're seeing a recovery in business aviation and domestic flying activity, where our engine flying hours have returned to 2019 levels during the period. Large engine long-term service agreement flying hours were 43% of the 2019 level, up from 34% in the second half of 2020. And this gradual upwards trend is still constrained by ongoing international travel restrictions and the uneven progress of vaccination programs around the world. During the period, we completed 284 large engine shop visits, 92 of which were major overhauls. Demand for new aircraft is expected to follow once existing fleets are well utilised. We delivered 100 large engines and 48 business jet engines in the first half, broadly in line with expectations. Civil revenue is $2.2 billion, some 13% lower than the comparative period. We returned to operating profit at £39 million. We continue to focus very heavily on the areas within our control and have seen substantial, sustainable cost benefits from our restructuring programme. We are well on the way to reducing the size of our civil aerospace business cost base by around a third. Our defence business, which is set out on the next slide, continues to perform well. Revenue of £1.7 billion is up 17% year on year. Operating profit is at £269 million, up from £210 million in the first half of 2020. We've seen continued demand and improved operational performance. This is driven by the continued resilience of our submarines business, coupled with early delivery of spare engines and higher spare part sales. That mix, which delivers better margins, has historically been more second half weighted. Now, that favourable timing and mix in the first half is expected to result in a stronger first half versus second half performance. So our full-year expectations for broadly flat revenue and profit in defence are unchanged. We have a strong order book, giving us confidence in that outlook, with more than 70% cover for our expected sales in 2022. In power systems, which we set out on the next slide, revenues were broadly stable in the first half, with an increase in services offset by a reduction in OE deliveries. Operating profit was $41 million, up from $33 million in the first half of 2020. We've seen a rise in higher margin aftermarket spare parts, partly offset by low factory utilisation on OE manufacturing. Now, the other point of note here is that order intake was up 19% to £1.4 billion. This is led by improved demand across all of our end markets, with particular focus in marine, governmental and power generation. Most of that recovery in OE order intake is expected to be realised as revenue over the next 6 to 12 months. We're also seeing interest in lower carbon solutions growing, and we continue to wisely focus our R&D investment on these products. Turning to the next slide, we've set out our funds flow. We saw a £1.2 billion cash outflow in the period from our continuing operations, which is a significant improvement on the £2.9 billion outflow last period. And just to help you understand it a little bit better, we've grouped this movement into 3 buckets. Firstly, we saw a trading improvement of around 1 billion. This looks through some of the noise of non-cash items and was driven by a fundamental improvement in EBITDA, thanks in large part to our cost savings. Our capital expenditure was lower too, in line with planned spend as part of the restructuring. Secondly, our working capital outflow was 1.2 billion better than the first half of last year. This was mostly due to the non-repeat of the unwind of invoice factoring. Our concession balance fell by 239 million, which was lower than we planned for due to third-party deliveries moving out. Our strong liquidity positions means we are not sensitive to the precise timing of the unwinding of these delayed concessions. Thirdly and finally, there are around £500 million of other headwinds year on year. Payments relating to the cash cost of closing out the over-hedge position in 2020 increased, in line with our previous disclosures, and you can see the detail of that in our supplementary slides. Interest and facility fees increased as guided, with higher average debt and committed fees on facilities that strengthen our liquidity position. Pension cash costs were higher due to a one-off catch-up on a payment that was deferred from last year. Our free cash flow is continuing to improve. The combination of restructuring and recovering end markets is putting us on track to get back to positive cash generation. We remain confident we can deliver on our guidance for around £2 billion outflow for the current year. Turning now to our balance sheet on the next slide. We ended the period with net debt before leases of 3.1 billion, and we expect to end the year around 4 billion. To rebuild our balance sheet and get back to an investment-grade credit profile in the medium term, we are very focused on executing on our disposals program, together with tightly managed operational improvements in driving positive free cash generation from the business. A strong balance sheet is important to us. We will balance the pace of that rebuild with the investment opportunities across our portfolio to make sure that we maximise long-term return for our shareholders. Our liquidity position is strong at £7.5 billion. That is after repaying the €750 million bond and the 300 million COVID corporate finance facility in the period. And we've recently extended the 2022 £1 billion unutilised loan facility to 2024. That means all of our debt maturities extend to at least 2024. We're confident in our liquidity position. It's strong, and we're not dependent on the pace of civil aerospace recovery. The disposals programme is progressing well, and we continue to target proceeds of at least £2 billion. We can't say much in detail here because of the ongoing processes, but we are having very constructive discussions and expect to achieve proceeds within the next 18 months. Early this year, our announced agreement to sell Bergen Engines was interrupted. We're now back on track, and you'll have seen the agreement that was announced yesterday. We're focused on getting the right results for our shareholders, and we will continue to do so in a measured way, with plenty of liquidity, and there are no near-term pressures as we rebuild the balance sheet. We will focus on making sure that we achieve the right value for our investors. Moving on to outlook. We've made a good start to 2021, and our guidance for the full year is unchanged. We continue to expect to turn free cash flow positive sometime during the second half of this year. We also expect a full-year free cash outflow of around £2 billion, which would represent an improvement of over £2 billion on 2020. This outlook was supported by continued resilience in defence, growth in order intake in power systems, a gradual recovery in civil aerospace, and our actions to drive down costs. As previously highlighted in our full-year results in March, our guidance does of course remain sensitive to the timing of OE concession outflows on already delivered wide-body engines. Looking further ahead, we are confident that when border restrictions are lifted, the recovery of international travel will accelerate. The recovery we are already seeing in domestic and business aviation is encouraging. Free cash flow of at least £750 million is still achievable in a 12-month period when engine flying hours exceed 80% of 2019 levels. However, given the uncertain pace of recovery in international travel and looking at industry forecasts, it is unlikely that this will occur in 2022. We have a clear pathway back to a net cash position in the medium term. We have plenty of liquidity to manage the uncertain pace of the recovery in engine flying hours in the meantime. We're positive on the near-term opportunities in both defence and power systems, the opportunities in our new areas of business, electricals and SMRs. We will remain agile in our response to external factors and continue to deliver on our restructuring, rebuilding our balance sheet and investing in our future. Before I hand back to Warren, let me just give you 2 minutes on what I'm very much focused on going forward. I've very clearly heard 3 things in meeting our investors. 1, make sure you deliver on the near-term commitments you've made. 2, simplify financial reporting. Make it easier for us to understand the business. And 3, set achievable targets for the medium term and then achieve them or even beat them. And here are my clear priorities, which I'm going to keep returning to and reporting against. We need to deliver on our commitments, and right now the focus for me is to realise the sustainable savings from our restructuring programme, making sure that the costs go out and stay out. That gives us a clear route to rebuilding our financial position. Last year, that was a very challenging one for Rolls-Royce, and we were well supported by our investors, lenders and the UKEF. As a result, we have around £3 billion of net debt today. That is too high. We will reduce it over the coming years. Secondly, we need to simplify. We need to break down the complexity in our financial communication. There is progress to be made in having a more straightforward way of explaining the finances in our business. I've taken some steps already to reduce the complexities, and there is more to come. And finally, as we look in setting those targets, we look to the future, we're going to continue to wisely invest in that future. We're at an exciting juncture with huge opportunity to lead our markets in the journey to net zero. We also have the opportunity to take our innovation and technology into new markets with incremental growth. And we won't stop investing in our current products. There are good near-term returns available from increasing durability and efficiency. So 3 things: deliver on the commitments, simplify how we report, and invest wisely. With that, I'll hand back to Warren.
Thank you, Panos, for the clarity there on our half-year results, and thank you for the insight into the priorities that we've been discussing. I'm now going to turn to the future and the opportunities to further progress our business. So, as many of you know, in June we launched our net zero pathway and targets, and although we operate in some of the hardest areas of the global economy to decarbonise, we showed our commitment to playing a fundamental role in meeting the challenge of climate change. Now, that doesn't mean that we're stepping away from our traditional markets, rather that we're applying our engineering expertise and technology to find innovative and more sustainable solutions which enable our customers to do things like continue flying without damaging the environment. At the same time, those solutions can generate additional growth opportunities for our business. On the left-hand side, you can see how a focused range of our interrelated technologies is applicable to decarbonise the complex critical systems in which we operate within a broad categories of energy, transport and the built environment, though there's not time today to discuss that part of the slide in depth. The main graphic demonstrates our technology pathway to net zero in 3 broad categories. With fuel efficiencies, new technologies and sustainable fuels, we can make a huge difference to Scope 3 greenhouse gas emissions by 2050. On the right-hand side, you can see compatibility with sustainable fuels plays a central role as we outline some of our net zero targets and commitments. These are also reflected in our remuneration policy. By 2023, we aim for all of our in-production commercial aero engines and our most popular diesel engines to be compatible with sustainable fuels. And by 2030, for all of our new products to be compatible with net zero operation. And in our power systems business, we aim to achieve a 35% reduction in lifetime emissions of new products sold. And by 2050, Our ambition is for all of our products to be compatible with net zero operation. Now, these are not simple goals. These will require collaboration across our businesses within Rolls-Royce, as well as within a growing and evolving ecosystem. So, looking to the future. Looking to our future strategy, it is about enhancing profitability in our existing businesses and developing growth opportunities triggered and enabled by the energy transition. The foundation is our large installed base. We're driving value in our existing portfolio through product enhancements that increase the efficiency of our products, so delivering more value to the customer, and also increasing durability. In our civil business, for instance, leading to increased time on wing and therefore increased profitability of our long-term service agreements. In civil aerospace, we're now entering a lower investment phase as our engine programs mature. Now our focus is on further productivity and efficiency gains, for instance, with increased use of digital technology. Meanwhile, we're ensuring compatibility of our civil and business aviation engines with sustainable aviation fuels, and our UltraFan architecture will deliver a further step change in efficiency, making it easier for our customers to adopt the more expensive SAFs in the long run. In power systems, we have a loyal customer base with replacement cycles that are regular and relatively predictable. And that gives us a great opportunity to work with those customers as we convert together, driving penetration of greener technology based around hydrogen, hybrid and pure electric solutions. We're also exploring ways to expand our network further into newer growth regions globally. In defence, our products have long lifespans which require us to provide upgrades and aftermarket services. We're also making investments in adjacent opportunities to expand our product portfolio further, and, as mentioned at the full year results, we estimate over £7 billion of lifetime value from tenders that are related to the B-52 re-engineering program and the US Department of Defense Future Vertical Lift program. We're also working with our defence customers on compatibility with sustainable fuels and opportunities for new and greener solutions. Now, the energy transition also creates opportunity for new business. In Rolls-Royce Electrical, we're focused on the electrification of aviation. For us, that's about applying new technology to a market that we know very well indeed. For instance, safety and weight considerations, of which we have a thorough and deep understanding, are absolutely paramount. This offers some of the most exciting and innovative areas for growth outside of our current portfolio. We now have over 300 engineers working in our aerospace electrical business, a fourfold increase over the last 2 years. And since we last updated you at the full year results, we've made excellent progress on the development of our all-electric propulsion systems for smaller aircraft. Our commercial contract with Vertical Aerospace, left-hand picture on the slide, is progressing very well around their eVTOL vehicle, and they recently announced pre-orders for 1,000 aircraft with a potential value of over $4 billion. Vertical also recently announced their intention to list on the New York Stock Exchange. In another subsector, we announced a collaboration with Tecnam and Widerøe to cover the development and delivery of the zero-emissions P-Volt commuter aircraft, that's the middle picture on the slide, targeting an entry into service in the middle of the decade. We're also now testing a 2.5 megawatt power generation system for use in hybrid electric propulsion. We saw a picture of that generator also on the front cover of this presentation. We'll talk more about Rolls-Royce Electrical and, for that matter, SMRs with our full year results, reflecting the way that we create focus on these areas internally in line with normal requirements for segmental reporting. Now, it's not just about developing new technology for markets we know well. The energy transition is also an opportunity to take technology we know well and apply it to new markets in pursuit of growth, and that's what we're doing with SMRs. So turning to SMRs, or small modular reactors, it's not just about developing new technology for markets we know well. No, the energy transition is also an opportunity to take technology that we know very well and apply it to new markets in pursuit of growth, and that's what we're doing with SMRs. Firstly, it's important to note that, as with Rolls-Royce Electrical, any SMR revenue generated will be additive to the current portfolio. And the reason why we see so much potential in SMRs is because they are affordable for both on-grid and off-grid applications, providing zero-carbon, non-intermittent electricity. But they're also scalable to create large quantities of zero-carbon power in a reasonable time frame, and it's increasingly clear that the world needs large-scale practical solutions fast. It's important to note that this isn't just about electricity for the grid. SMRs are ideal for the production of zero-carbon hydrogen, synthetic aviation fuel, and other sustainable fuels, so further enabling the production of clean energy for a range of different sectors and applications. And as countries around the world seek to comply with their legally binding carbon abatement targets, the stable supply of low-cost power becomes incredibly important. Our SMRs fit that need perfectly, creating a substantial global opportunity, even though our initial efforts, highlighted here in the timeline on the slide, are focused on a UK grid-based application. We're particularly excited just now as we're in the process of forming a special purpose vehicle to take the programme forward into the next stage of its development, and we intend to enter the UK regulatory process this calendar year. We'll step through the regulatory and policy processes in tandem, and we'll be targeting first power to the UK grid around 2030, with export orders following shortly thereafter. So let's summarise. I'll reiterate some of the key points for a takeaway. First and foremost, we're delivering on our financial priorities. Our restructuring is on track and delivering the results that we expected. Our disposal programme is also progressing well towards our target of at least £2 billion in proceeds. Our cash flow and profitability are both showing significant improvement, and they're on track for our 2021 guidance. And we have the strong liquidity and clear pathway needed to get back to net positive cash and an investment-grade profile. Furthermore, as we look forwards towards a low-carbon future, we will play a leading role in the transition to net zero carbon emissions by 2050. And that is through both decarbonisation of our existing businesses and through multiple exciting growth opportunities for incremental business. And with that, I'd like to thank you all for listening and hand over to the moderator for Q&A.